Welcome back. Financial Issues, 866-300-9298. If you want to weigh in, the Dow closed up yesterday, 108. So big gains yesterday. We'll see what happens in the midst of some numbers that have come out this morning that aren't looking so good, particularly earnings in the financial sector. But we'll see. It closed up yesterday, 108. So that's good news. 866-300-9298. If you want to weigh in, 866-300-9298. Listen, I want to remind all of you, just in case I don't want you to miss this, that we are doing a special today at the end of the second hour. If you are a homeschooler listening to me, and I know I have many, which is a lot of fun. If you are a homeschooler listening to me, and I sure appreciate it, or you are a mom or dad of homeschoolers, maybe you're a dad on your way to work, you need to call back home. Tell them that whatever the kids were going to do at 9:20 Central Time this morning, to sit back, if they're high school, I would say, 7th grade on up, that they need to watch the special that we're running. It's only 2 segments. It's not that long. And you can go to AFR.net if they want to watch it, sit around the computer and watch it at AFR.net. It would probably be a little better watched than it would be listening to it, although listening to it's fine too. And it is an opportunity to hear some of the excerpts from Fed Up. If you like it, if you want to hear more, if you want to learn more, then you can get the DVD. That would be a huge blessing to the ministry here at AFA, and sure would appreciate that. But there's going to be some very interesting conversation that I'm having with guys like Steve Forbes, T. Boone Pickens, John Allison, the president of the Cato Institute, Dr. Robert Jeffers, Dr. Michael Youssef, some Ben Stein, many others, some great stuff. And I really hope that you can listen. Now, here's the thing. If you're a homeschooler and you're watching this, make sure that you're taking notes. Don't sit there and watch it. Just take some notes, because you're going to hear some things that you might not understand. You may even hear some things that just don't make sense to you. You need to write it down. And here's what I want you to do. I want you to research it. Research that, whatever that is that you don't understand, I want you to research it. Do that. And then, or you can call me and tell me about your research. I hate to tell you to just call me and I'll give you the answers, because I want you to do the research, because it's how you're going to learn some vital information about the economy and what makes us tick. So I know you're going to enjoy it. I hope you'll do that. I hope everyone will join. It's going to come up here at 9:20 Central Time, 9:20 Central Time, 10:20 Eastern Time. And if you're watching on Biz Television, listening on other networks, I hope you'll join us, because it's going to be good stuff. And I know you're going to find it interesting. We're going to get to the phones as well, 866-300-9298. Here, folks, listen, let me just tell you, I put this on my Facebook page as well. So, Treasury Department, there was a number that came out of the Treasury Department last night. Somehow it managed to escape, got out to the public. It was supposed to be out at 9 o'clock this morning. Well, kind of moot point now, because it was leaked. And it basically says that the holdings of U.S. Treasuries have increased a record $12.2 billion. $1.3 trillion now, after this $12.2 billion record buys from China, is what China is holding. The article goes on to talk about this. Is it, China's swelling foreign exchange issues is now up to almost $4 trillion, and 1.3 of that being U.S., and is that of some concern as our largest, debt holder? No one is talking. So I sent this out on Twitter and I said, it's pretty pathetic, something to this effect, that it's pretty pathetic that we're looking at China's $1.3 trillion of debt, and nobody's even talking about the Fed's $4 trillion worth of debt that they're holding. What's the Fed? I mean, it's a private institution. What do they have that China doesn't have? Why are we concerned about China? We got the Fed. The Fed, our largest debt holder. $4 trillion. Nobody's even talking about it. Everybody's still saying, well, China, our largest debt holder. Really? If anybody's saying that, they still have their head deeply planted in the sand. Because the idea that China is our largest debt holder is ludicrous. Listen, 1.3 trillion by communist China is not a good thing. Don't get me wrong. But 4 trillion by the Federal Reserve is not a good thing either. But nobody's talking about that. You can read that article if you'd like. I think I'm going to put it in my newsletter this week, too. So you might want to check that out. 866-300-9298, 866-300-9298. And we're going to get to calls yesterday. I'm waiting to see what the indices open. It looks like they're going to open in negative territory. Oil is on its way up, by the way, as we speak. It's up over yesterday. Excuse me, yesterday anyway. And we'll continue to watch that. I'm trying to get the number, but my computer is hesitating on me here. Here we go. So oil is at 94.15, unfortunately. We were at 92 yesterday. 94.15. Natural gas continued to rise 4.47. Gold is up $2.60. It is up to $12.40. Silver, 2013. All the agricultural commodities, all of them, are in positive territory. The biggest move that we're seeing right now is in cotton. Cotton's up about 1%. Corn's up second at about 0.75%. Let me go to Dale. Dale is calling us from Tennessee. Hey, Dale.
Hey, how's it going?
Good.
Hey, got a question. I've got a stock trade account that I play with a little bit, and I have had a lot of stocks on my watch list that have done extremely well. But the problem is they're on my watch list, not on my positions list. And the reason that's the case is because there are so many of them that when I started watching them were close to or at their 52-week high.
Mm-hmm.
And I've kind of thought, well, it's probably too expensive, but I've just watched them go up and up and up over this year, and I'm having a hard time with finding value in some cases. And I guess, are we at sort of a new normal for stock valuations? I mean, there's so many stocks right now at their 52-week high.
Mm-hmm.
Is that going to be kind of the new normal, and we're not going to see a decrease anytime soon, you think?
No, we're going to see a decrease, and it's not the new normal. There is going to be a change. You did the right thing. Look, you got to stick to a certain discipline, whatever that discipline is. Your discipline may be different than my discipline, but the fact of the matter is, I don't have anything on my watch list, frankly, that is at a 52-week high that I can think of. I might have a couple things very close to that. There's value out there. I believe everything on my buy list is a value even right now. So there's plenty of value out there. I can't speak to the stocks on your list because I don't know what sector they're in, or I don't know what companies they are, and all those kinds of things. But there is still value out there. It's harder to find. My buy list is extremely small for a number of reasons, though. Not just because of lack of value, because I think there is going to be this pullback, and I'm trying to be a little cautious. But so no, I don't think it's the new normal, and I don't think you should perceive it as the new normal. I will say this. There are companies that I have purchased over the year, have put into portfolios, whether it be my institutional money or individual money, back when I was managing individual money. I'm not managing anything now but a couple private institutions. But there are stocks that I bought near a 52-week high because I bought them with the idea that I'm going to totally forget about it for the next 20 years. And that is the case. And I really never looked at it, really didn't care much about it. There are companies right now that are at 52-week highs that are, if you're going to keep them for 10 years, it's kind of irrelevant. ExxonMobil, one. There's a number of others that are 52-week high. And if your desire is to build a solid portfolio with solid positions, then, there's no sense in trying to time it. Buy those good, solid companies and just hang on. But if you're going to lose sleep over every time they get off that 52-week high and they start to dip dramatically, then don't buy them. But the fact of the matter is, if it's a good, solid company, is it going to experience a pullback in the next 2 years? Absolutely. But again, if it's 10, 15 years, whatever your long-term horizon is, say it's an IRA account and you're 20 years away from retirement, I wouldn't even worry about it. I wouldn't even think about it. So, look, the object, the goal should be, Dale, the goal should be quality. And simply that, just good, solid, quality companies that have great staying power, regardless of the economic circumstances. And so it sounds like I'm describing defensive stocks. I am, because I try to stay defensive. I think you can make a lot of money always being defensive. I have not every stock on my list would be classified as a defensive stock, but nevertheless, a lot of them are as well. So, I think that you can't get too caught up on that. I do an enormous amount of analytical work, and I have stocks that don't hit my buy list for years. Great, solid companies, but they never get to my buy list, not only because of some fundamental financial reasons, but for other reasons such as momentum in the marketplace in the sector they're in, and maybe some art form kinds of things that I believe are important things of keeping my ear to the street and kind of knowing what that company is going to do or what it may be doing soon and those kinds of things. But nevertheless, I don't think this is a new normal. I really don't. There's never, ever, ever going to be a normal by which every year all stocks, every year for the rest of time, make new 52-week highs and continue to go up from that last 52-week highs. That's never going to be the case. Never has been, never will be. I believe that what we have seen is a phenomena from the Fed. It's the cheap money. It's the free money. It is the manipulating of balance sheets. It's companies making profits without really creating more expenses. That is a very good thing, obviously, for any company, for any balance sheet. Stock buybacks have been at record highs for the last 3 years. Companies buy back their stock, drives the price up. Not only does it drive the price up, but it takes shares off the market. So there's less shares to buy. So as the price is going up, it creates demand for fewer shares. That also drives the price. So there's a lot of those kinds of things going on. The stocks are not going up. I don't care what anybody says. And there's a lot of people that will and have argued with me on this. But stocks are not going up because of the fundamentals of the economy. They're just not.
Yeah,
it's just it's not happening.
Yeah,
go ahead.
I didn't feel like the fundamentals of the economy were contributing to these higher prices, and I guess that's kind of what I've struggled with. Is I felt like I've been prudent, and I've watched all this money I could have made, go away. But
yeah,
do you think that we're ever going to see a day where the market will be back to the Dow will be back to like the 10,000s?
No, I don't know that we're going to see that. Now, we may see that on a very temporary basis during a major correction or recession or possibly even a depression. Then, of course, we will. But I don't think it's going to be prolonged. I don't think it's going to be, something that is going to last forever. I don't think there's going to be a new starting point of 8,000 on the Dow that is just going to trickle up higher till, 20 years later we get to 16,000. I don't think that's going to happen at all. So I do think we're going to see that dip, but I don't think it's going to be long lasting if the economy turns around, unless the economy goes bankrupt. So, and we go over the cliff. But let me just make a couple points for you, Dale, just for your edification and thoughts as you think about your strategy and all the other listeners. First of all, don't ever look back, because you should never, ever complain because you've erred on the side of prudence or caution. Because had the market gone down last year, you would have looked like a hero and you would have felt very good. And let me just say, there is always value in not losing anything. There's always value in that. Now, and having said that, I've never made a case on this program or on my asset allocation models ever, or even today, knowing that this correction is coming, that people should be 100% in cash. I've never made that argument. What I've said is, should you have 40, 50, 60% in cash, depending on, your situation? Yes, because you want to preserve a significant portion of your portfolio should things turn down or when they turn down. But you need to always also have positions in stock. You need to hedge. You need to play both sides of it. So if you had 50% in the market and 50% in cash, and the market goes up 30%, you make 15. That's not a bad thing. And, so you've done well. If the market goes down 30, you're only down 15. That's a good thing. So you need to hedge both sides of it. And I've never made a case for 100%. So don't do anything 100%. No more than you would put 100% of your money into one stock. So good stuff, Dale. I appreciate your call, and just hang in there. If you have a discipline by which you're working and you feel confident in that discipline, and you're doing the right thing, by the way, by looking at the fundamentals of the economy and not getting caught up in this false positive that is in the markets right now, I think you're doing the right thing. I would stick to your discipline, but that doesn't mean you shouldn't own some good, solid, tried and true companies that are in the next 10 or 20 years are going to do well. Thanks for the call, Dale. I sure appreciate it. 866-300-9298. 866-300-9298. We're going to get right back to the phones after this. Financial Issues. I'm Dan Celia. We'll be right back.